Welcome back to the Wall Street Podcast. Today we're doing a deep dive into some key pieces from the Wall Street Journal, published this Wednesday, September 24th. We'll be pulling together updates on monetary policy, big tech finance, some major corporate deals, and how new regulations are playing out.
Exactly. We want to connect those dots for you. And just for context, the 10-year Treasury yield was sitting at 4.117% earlier, a really key benchmark. Oil was also trading a bit lower, around $63.41 a barrel. That's down about $1.13.
Okay, let's start with the Fed. After that rate cut, Chair Powell called the current stance still modestly restrictive. What's the significance there? That phrasing seems quite deliberate.
It absolutely is. Modestly restrictive basically signals they feel they have room to maneuver. Powell suggested more wiggle room to reduce rates this year if conditions warrant. And importantly, a slim majority of Fed officials are now projecting at least 2 more cuts by year-end.
Right, 2 more. And this potential easing comes alongside, well, a slightly better global outlook than maybe expected. The OECD updated its forecast.
It did, yes. For the U.S., they're seeing GDP growth around 1.8% this year, then 1.5% next. But globally, the forecast is actually stronger, 3.2% growth this year. That's up noticeably from the 2.9% they projected back in June.
Interesting. Okay, shifting over to corporate strategy and, well, big money moves. Some significant deals were announced.
Definitely 2 that stood out. Sempra selling a 45% stake in its infrastructure unit to KKR affiliates. That's a $10 billion deal. And then Eli Lilly announcing a huge $6.5 billion facility down in Houston. They plan to make active pharmaceutical ingredients there, including for their new oral weight loss drug. That's a major manufacturing bet.
A huge bet indeed. Okay, first commentary point. Yeah. With those potential Fed rate cuts, why do analysts expect such a quick impact on commercial real estate, the CRE sector?
Well, it really comes down to debt structure. CRE financing often involves shorter-term or floating-rate loans, unlike, say, typical 30-year home mortgages. So when rates fall, the relief on debt servicing costs can be almost immediate for property owners. This tends to prop up building values pretty quickly, can encourage sales, and maybe make projects like office-to-apartment conversions look more feasible again. It could help reverse that, 20% value decline since 2022.
Right, the debt sensitivity. Okay, now for something really eye-catching. Nvidia's role in AI. They're planning to invest up to $100 billion in OpenAI for a massive computing build-out, part of a potential $1 trillion total infrastructure cost. What's the financial thinking behind a move like that?
It's about leveraging balance sheet power in a very strategic way. Analysts are calling it circularity. Essentially, Nvidia provides the funding, which cash-strapped firms like OpenAI desperately need for these huge compute warehouses. But that investment, in turn, guarantees massive ongoing demand for Nvidia's own chips. It locks in a huge customer, so it's less a simple investment, more a way to secure future revenue streams, you see.
A self-feeding loop, almost. Okay, let's turn to regulation and a pretty contentious topic that proposed a $100,000 H-1B visa application fee. There seems to be a real split here.
There really is. You have some executives like Reed Hastings at Netflix who argue it helps filter out applications for lower value jobs, focusing on truly high impact roles. But on the other side, especially from startup founders, the argument is that this creates a huge barrier. They say only big tech can really afford that kind of fee per hire. For smaller, innovative companies needing specialized talent, it's potentially prohibitive. Some predict it might just push more operations offshore faster.
So a real concern about stifling innovation versus filtering applications. Finally, let's bring this down to the ground level. How are things like tariffs and recent job cuts actually hitting the public right now?
We're seeing clear signs. Take AutoZone's results. Their comparable sales grew 4.5%, which sounds good. But profit was lower. That suggests people are still making mandatory repairs, but they're absorbing higher prices, likely due to tariffs on imported parts. You have to fix the car, so you pay more. And in places like Seattle, the tech layoffs, particularly from giants like Amazon and Microsoft, are having a measurable impact. Tens of thousands of jobs gone since 2023. This has led to a projected city revenue shortfall of $146 million. You can even see retail and restaurant spending in downtown areas down by as much as 7%. It's a direct hit to the local economy.
Real, tangible effects. Okay, to wrap up, here's something for you to think about. The kind of money being discussed for AI infrastructure, up to $1 trillion potentially just for OpenAI's needs, that figure dwarfs the annual GDP of many countries. As these AI capital demands keep escalating, what scale of investment maybe previously unthinkable is going to become the new normal across industries?